Alright, welcome back to the fourth part of chapter 20. We were looking at the proposed policy, the change in credit policy should increase total sales, and it will increase sales unit. The sales unit will contribute to higher total sales. And sales price may also increase. But at the same time, cost may also increase. Therefore, generally, the increase in cost, there will be an increase in sale price or the increase in sale unit. All these three together, considered together, they should increase total sales. But of course, increased cost will reduce the cash flow for the company, because we are looking at net cash flow, cash flow after deducting costs, right? But the proposed policy should also delay collections. So this is actually another cost. So this is highlighted in pink. These two, these are actually reducing the benefits or increasing the cost from this change in credit policy. So the question is the delayed but increased sales worth it? That's a one-line question. So you want to answer that question in the analysis. Okay, is the present value of later but higher cash flows higher? Okay, meaning higher present value. If it is higher, then we should change the credit policy. But if it is not, then we should stick to the current policy, which is the cash policy. Is that okay? So that's how we should do the analysis. Now, this is the solution given in your slides for the problem that we have seen earlier. Now, I'm not going to go through this because this explanation is a bit complicated, and I think it's more difficult to understand. I'm going to show another method. Okay, so the same solution, but I show it this way, using this table. This table. Now, this is this month or now, times 0. Consider this as times 0, and this is every month. Why every month? Because the credit policy is net 30. Remember, so 30 days is 1 month. So we will have this, meaning every month. The first month, second month, third month, and so on, until infinity. So this is why it is labeled as every month, every other month, every month. This is current month or now, times 0. Okay, now we have new policy versus old policy, because in our analysis, remember, we should look at incremental. The word incremental is important. Incremental means relative or comparative. You compare new policy with the old policy. That is why we call this incremental. Incremental cash flow. And then we look at the net present value. That's how we are going to do the analysis. Now, with the new policy, what will be the cash flow now, and what will be the cash flow every month? Okay, that's what we're going to look at here. And then with the old policy, what will be the cash flow now, and what will be the cash flow every month? Okay, and then the incremental is simply this minus this. The new policy minus the old policy here. New policy minus the old policy. This is what we mean by incremental. That means difference, relative difference. This compared to this, compared to this, how much higher or lower the new policy is. That is what we mean by incremental cash flow. Then net present value, will look at all this at present value terms. Remember, this is at different time. This is a perpetuity, because this occurs every month, forever. So this is perpetuity, this is now, this is current. Okay, let's look at the new policy. With the new policy, this will be the new sale cost. This is Q1, this is the quantity of sales made, okay, with the new policy, multiplied by the variable cost per unit. Now, this is 1050. Remember the problem that we looked at in the previous clip? Okay, it says that with the new policy, the company will be able to sell 1050 units. Okay, now cost per unit is $40. It doesn't change. Now, when you sell with the credit policy, new policy is actually net 30. Therefore, when you do that, you sell, you incur the cost, but you don't collect. Is that okay? So this is the cost. The total cost will be the number of units multiplied by the variable cost per unit. So it will be negative 42,000. That, the new policy, will be a cash outflow. This is a cash outflow, because once you make the sale, even though you don't collect, you actually pay for the cost of each unit. The cost is $40. Therefore, you make a sale of 1,050 units. Therefore, total cost is 42,000. This is the cash outflow. Is that clear? All right. Now we look at what will be the cash flow now under the old policy. Then only we can compare. Now the cash flow with the old policy will be the foregone. That means you forego this. Foregone old sale collection. So with the old policy, you sell Q units, QO. Remember, this is Q1, 1,050. This is the old sales unit, 1,000. QO. 1,000 multiplied by price minus variable cost. Note this. The price, because you collect now, this is cash policy. You sell, you incur a cost of $40, but you collect immediately, so you get $100. You pay 40, but you gain 100. So for every unit, you gain a $60 margin. $60. So you multiply with 1,000, you get 60,000. This is a cash inflow with the old policy. Is that clear? Okay, this is what you forego. Why you forego this? Because you switch from the old policy to the new policy, right? Okay, now we want to see what is the incremental cash flow. Incremental cash flow is this minus that. So it is simply this. This is stated in the formula. This formula here minus this formula here. All right. So in terms of value, it is negative 42 minus 60,000. So it is negative 102,000. What does that mean? It means that if you switch from the old policy to new policy, you will have a cash outflow of $102,000 now. Now. What does that mean? Why is 102,000? $42,000 will be from the sale of new sale cost. The sale of the cost of sale under the new policy. Okay, it will be 42,000. This is an outflow. This you forego this inflow under the new policy, because it's an inflow with the old policy. Because you switch to the new policy, you will lose this. You lose this. Therefore, this will also be a negative. Negative 60,000. So you lose this. This is a cash outflow. This cash outflow and this is the cash outflow. Therefore, total cash outflow will be $102,000. Is that okay? All right. That is now. These are the cash flows now. What are the cash flows every month? With the new policy, what happens? This is the formula. Q1 multiplied by P1 minus V1. Why minus V1 here? P1 here because you collect. You sell this month, you collect the next month, right? So you make the collection. The sale that you make now is collected in the next month. Because net 30. You sell now, you collect 1 month later. All right. Now, when you collect 1 month later, you also make another sale. You make another sale because the sale unit is 1,050 per month. So at the end of the first month, you make the sale for the second month. You collect for the first month. At the end of the first month, you collect for the first month, but you also make the sale for the second month. So there will be a cost. Okay, you collect for the first month's sale, but you also incur the cost for the second month sale. The beginning of the second month will be at the end of the first month. Therefore, 100 minus 40. So you make a $60 gain. The quantity is the same. The amount that you sell every month is the same. This is fixed. 1050. Therefore, you collect, but you also incur the cost for the coming month's sale. So therefore, these two occur at the same time. So therefore, you can add or minus. Remember, The cash flows, when they occur at the same time, you can add or you can minus the cash flows. But if the cash flows are at different times, for example now, and this is every month, they're not at the same time, therefore you cannot add. You cannot add across, but here within the same time you can minus. So 100 minus 40 multiplied by 1050, you get 63,000. This is what you gain. This is the net cash flow from the new policy every month forever. Note that this is a perpetuity. If you just switch to the new policy will give you a cash inflow of 63,000. Now what is the cash flow with the old policy? Old policy will be the same as this. Same. This here and here is the same, because you sell and you collect immediately. So here for the first month you sell and you collect now. Therefore the cost is also incurred now. So all you can add, because they are the same time. Here the same. For the next month you incur the cost of sale at the end of the next month. Then you also collect at the end of next month. You sell and you collect immediately. Therefore this will be 60,000. 1,000 units multiplied by $60 per unit. This is the profit margin per unit. So you get 60,000, right? $60,000 every month. Now what is the incremental cash flow? Incremental is this minus this. Incremental here means what is the benefit or the difference of the new policy compared to the old policy, the cash flow. This cash flow minus this cash flow is of course $3,000. Now note this is the cost that you incur if you switch from old policy to new policy now. This is the cost now. This is the benefit you get every month. Note this is not one off. This 3,000 is forever. You get every month forever. That means this is the perpetuity. So how can you compare? This is 3,000, this is 102,000. Negative. This is positive 3,000. It means that now with the new policy you lose $102,000, but with the new policy you actually gain $3,000 more every month forever. Okay, so which is better? Okay, so you need to bring this, they are at different times, you cannot compare directly. You need to bring this to present value. This 3,000 to present value. Note that this is a perpetuity. So what is the present value of perpetuity? You take the perpetuity, divide this by the discount rate. Now the discount rate here must be for 1 month. Okay, remember in the problem the interest rate per month was given as 1.5%. Therefore we take this. This is the full formula. Note this. This is the formula for the incremental cash flow every month. Okay, this divided by R. R is the discount rate. Now it was given as 1.5%. So 3,000 divided by 1.5%, that is 0.015. Therefore this, even though it is negative 102,000 here, but this is higher than that. So this is 200,000. So you get net cash flow or net present value now is 98,000. What does that mean? It means the present value of your benefit of $3,000 per year, per month, for forever, is worth this much, $200,000. But the cost now that you incur when you switch to the new policy is 102,000. Therefore your benefit is more. Your benefit is more than your cost by $98,000. So therefore the net present value is positive. Therefore you should switch to the new policy even though the cost now is high. Remember, the overall benefit in present value terms is positive. So you should switch to the new policy. That means you should provide the credit to your customers. Net 30. You should not use the cash policy. You should switch or change. Is that okay? Alright, so we move on to the next slide. Okay, this next slide just gives you the summary of the formula. Yeah.